Yo, thanks for joining. Welcome back to the channel. Listen, before we get into today's video, how are you? How are you doing? Me personally, I'm great, fam. Tony the Tiger. If you don't know, you're too young. I'm great, fam. This is exactly what we needed. This is exactly what the market needed. And this just gave us an absolute divine opportunity. I'm even going to use the word divine. Imagine that it gave us a divine opportunity just to remember why we're in the stock market, to recalibrate, rebalance the scales, and make sure that we're only invested in businesses that we genuinely believe in for the long term. And those businesses have been on a run up like crazy. So it's given us an opportunity to buy those businesses. I talk a lot about BO, not because I stink, but because there are buying opportunities everywhere, and this week presented many buying opportunities. So yeah, I love this week. It's been a great week, and we're going to talk a little bit about this week, how it's basically unfolded. We're going to talk about the top movers and fallers within my portfolio. We're going to talk about 5 stocks that I've sold this week. We're going to talk about 1 stock that I've bought this week, and we're going to talk about 3 stocks that I've added to their positions this week because I saw them as nice buying opportunities to load up on that. So listen, tap that like button, let's keep it moving. Subscribe, hit that bell, and my link will be down below if you're new to investing. freetrade.io/infant-investors. Click on the link, sign up, deposit £1, you'll get a free share of up to £200. But let's get straight into the top movers. In fact, let's rewind, let's backtrack. Before we get into the top movers, this graph is looking skunked right now, so I'm just going to basically explain what's been happening this week. It started like every week does, just a normal week in the market. And then, right here is fake news. I didn't have this amount in the portfolio. This is completely fake news. This is just based off the stock split stuff that was happening earlier on this week. So what was happening in most people's profiles is basically the new stock price in the back end was adjusted. However, in the front end, because the market hadn't opened, you were seeing the original stock price. So it was looking like this was your portfolio growth performance, but it's absolutely fake news. And obviously when that market opened, then obviously it dropped back to normal. Then the market was okay for a bit, and then obviously it started to on its trajectory down, which doesn't look that wild now because of all of the stuff that's happened within my portfolio. But then you can kind of start to see it drop significantly here. This big spike up for me, I'm going to explain later on in this video, but essentially some money came into this account for me to begin investing into some of my other businesses as well. And then obviously the market carried on falling towards the end of the week. So yeah, the graph isn't the best illustration of it, but it's been a bit of a crazy week. I've probably dropped around 3k in terms of the value of my portfolio, so I'm down about 3k from this time last week. But it's all good, it's all good, it's all positive stuff, man. And we will be laughing this time next year, hopefully. September is typically a bad month as well. A lot's been going on. Obviously the whole election that's coming up as well is going to potentially provide a lot more uncertainty and volatility in the market, so we're going to have to wait to see what's going to happen there. So yeah, definitely do all of the stuff that you guys we talk on the channel. Make sure you are looking at the fundamentals of the company. Make sure you're buying into businesses that you genuinely believe in for the long term, and try not to worry about these small market swings. This is not even in correction territory. Like, most stocks didn't even reach 10%, so it's not even really a correction. It's not technically that bad of a fall, and we've seen a lot worse throughout the 2 years I've been doing this channel. So I wouldn't even worry about it too much. If you've got stocks on your hit list, it's a good time to definitely get into it. But let's get into the top movers now. And the first top mover to talk about is PayPal. So PayPal went up 0.25% this week. Now, nothing new this week. Obviously, the way this channel goes, for anyone that is new, we talk about the top 3 movers and the top 3 fallers on a weekly basis. Now, obviously, there are stocks that I hold which won't make the top 3 movers and the top 3 fallers. So sometimes there might be news surrounding those stocks, but we don't talk about it within this week's or that week's update. So I'm going to talk about some of that previous information for PayPal that didn't obviously make some of the previous videos. But one thing that I've noticed is that PayPal has been increasing their debt recently. So previously, at the time that I invested into PayPal, which was about nearly a year ago, December last year, when I started investing into it, it was a debt-free business. But recently they've been issuing corporate bonds. Now some people can look at debt as a negative thing. It can be a negative thing, but it all depends on the business, and there are obviously reasons for doing so. PayPal issued corporate bonds on a 3-year, 5-year, 10-year, I think 30-year basis. The actual interest that they're actually paying on those corporate bonds is less than the fees they make on a per transaction basis, during their normal operations. So, for them, it's actually worthwhile being leveraged, because using other people's money is actually more cost effective than them using their own money, and they can actually use that to reinvest into the business, to buy or make more acquisitions, and to further supercharge and grow their business. So actually, in the case of PayPal, raising debt hasn't actually been a bad thing for them. They did it off the back of great earnings, and I just still think PayPal is going to continue to grow and be an amazing company. PayPal has already got a higher market cap or valuation than I think Goldman Sachs or JP Morgan, one of them. I think Goldman Sachs valuation got superseded by Square this week as well. So these new payment businesses are definitely making waves, and there's a lot more that they can obviously go and divest and do in the future. So it's definitely going to be interesting to see what happens with PayPal. It's not one of the stocks incidentally that I added to the position, but it's definitely something that I'm going to be doing over the next couple of weeks. So I just need to work out between the new stocks that I want to get and the money that I've got in my ISA, and whether I should do it within trading 212 or within my free trade ISA. I'm trying to work all of those things out, because we're going to talk a bit about that later on in the video. But definitely I'll be holding PayPal in the long term, and I love this business. The next stock that is a top mover this week is Okta. So Okta was a top faller last week. It was a top mover the week before. It was a top faller the week before that, and I think it was a top mover the week before that. So it has had a little bit of volatility, but to be honest, this week was actually quite an important week. So when you think about all of the tech stocks selling off, and Okta basically managed to maintain its valuation throughout that period, that shows a lot of good resilience. That shows a lot of good resilience in a climate where a lot of stocks were selling off. And obviously it maintaining at 0.38% for me was good, and obviously ending the week in the green. This is a pandemic proof business. We've talked about it on quite a number of occasions, because it's always either been in a top mover or top faller for many weeks. And again, Okta is something that I'm going to add to. I'm going to add to my Okta position, and keep that for the medium term. Probably not as long as a PayPal. I probably would sell this stock once it's in a decent amount of profit, and then reinvest that into another business. But at the moment, I'm more than happy to continue holding into Okta. We talked a bit about some of the headwinds that it might foresee with their their small to medium sized enterprises. Because of their balance sheets, they're actually potentially not able to continue running the Okta service, whereas the large enterprises still need Okta. So their revenue and their next earnings might be a little bit shaky, but we shall see. Overall, I'm still more than happy to hold Okta. I think it's a good business for the medium term, and my medium term, I'm probably talking like 1 to 3 years. So we'll see how long. Obviously, it kind of nestles within that period, but I'll definitely add more to this position and definitely hold it for that medium term period. So yeah, Okta is the second top mover. The third and final top mover, the toppest mover. I know that ain't a word, but it's my word. So yeah, just do one in it. The toppest mover for this week is Imperial Brands. Imagine that. Imperial Brands being a top mover for this week, going up 4.07%. One of the reasons why Imperial Brands has gone up this week is because JP Morgan has upweighted their rating of Imperial Brands from neutral to overweight. So they basically believe that the current share price has priced in a lot of risk, and their downside risk especially, and so they've got a price target now of £16.50. So that's one of the reasons why Imperial Brands has gone up. I think also when stocks go down in the manner that it has this week, where pretty much everything is going down across the board, it wasn't just tech stocks in the US. We saw a lot of the FTSE 100 close, way down this week as well. So a lot of UK businesses, a lot of US businesses in the Eurozone that I don't really even watch too tough, to be honest, but they obviously closed down heavily this week. When you see that, it can be symptomatic of a couple of things. It could just be a correction or a reversal and a bit of cooling off, which I think primarily is the reason, especially when we're talking about the tech stocks. But it also could be obviously symptomatic of a greater issue that might manifest later on, that maybe smart money knows about, that us retail investors don't really know about. So something to do with interest rates, or something to do with the way the direction that the market's going due to the recession or unemployment, or all of the other factors that we talk about from a economic standpoint. I think in the case of Imperial Brands, there's probably been also a little bit of a benefit to the fact that people might be thinking we are in a recession, and historically gold and consumer staples that people can't live without, particularly things like cigarettes, does do well in recession times. So that might also be part of it, but that again is just conjecture. There's no real data to back that up. It's just the climate that we're currently in at the moment would suggest that might be part of the reason as well. But I think generally speaking, it's to do with the fact that it's been upweighted. Those analyst lows tend to have quite a big impact, and me personally, it didn't become one of the stocks that I sold this week. Interestingly, it should have been, but one of the reasons why was obviously what we've just talked about, but also because of what's happening, I want to kind of get some confirmation about what is actually happening in the market over the next couple of weeks. If it is just a tech stock reversal and then it just starts to rally off again, then it'll probably get sold next week. If it isn't and it's something more symptomatic, then I might ride this for a little bit longer, and we'll see what happens there. Maybe I can recoup some of the losses that I'm currently experiencing with Imperial Brands. But in the main, whatever happens, sooner or later this stock will be gone. That's a fact. It's definitely going to leave my portfolio. It's just a matter of when and not if. But interestingly, a little bit of a parting gift, Imperial Brands was the top mover for this week. Now, in terms of the top fallers, the first top faller to talk about is Legal and General. So Legal and General has dropped 5.98%. And for me personally, I'm more than happy to keep holding Legal and General. I think it's a very well-run business, very well-run British business, one of the few, in my personal opinion, from an investor perspective. And so, yeah, I'm definitely going to continue to hold. I'm going to talk a little bit about my ISA allowance situation at the moment. So I don't know if I'm going to add that much more to Legal and General, just primarily because of how much ISA allowance I've got remaining until April 2021, and so it's probably not going to see that much more money, because I'm going to need to use that and utilize that for other tech stocks and other US stocks that I want to get into, or adding more to existing positions that I've got. But I'm definitely just going to hold Legal and General for the time being and just keep recouping that dividend when it does pay it, and obviously reinvesting that and just leaving it for the time being. So yeah, this wasn't one of the stocks that I sold either this week. I've always raved quite highly about Legal and General, and yeah, I will continue to hold Legal and General for the foreseeable future. The next top faller for this week is Tesla. Imagine that, Tesla. It went down 8.06%. Listen, we're going to talk about Tesla later on when I talk about the stocks that I've bought and I've sold. So yeah, stay tuned later on in the video for that. The last and the main top faller for this week is Cloudflare. So Cloudflare has gone down 8.63%. Listen, the problem with looking at stocks on a weekly basis is that, you could potentially start to panic when you see certain stocks having, consistently bad performances early on and so forth. And this is the whole concept of, trying to time the market and, how active you want to be within your portfolio. I think there's pros and cons to everything in life. And, being an active investor means you need to actively be part of your portfolio, look into your portfolio, research your portfolio. You need to actively be involved in the businesses that you're invested in. And by involved, I don't mean you to work for them. I mean, you need to be involved in the affairs of the business and understand what that business is doing, and obviously make adjustments and decisions accordingly. But at the same time, some of the cons of that is that every single movement you can potentially overthink. I'm not overthinking this situation. Cloudflare, as I mentioned to you, is at least a 5-year play for me. I genuinely feel like in 5 years, this could be a stock that I might see 3, 4, 5, 600% return on. Potentially, especially if I think in around the 3-year term, it will actually become a profitable business. And if that continue to grow, then, this is going to be like, those AMD stocks for the last 5 years, or, those Alphabet stocks for the last 5 years, or Apple, etc., etc. So, looking at it on a week on week basis for me just says, if it's gone down this much, then buy more. So that's exactly what I did. And, spoiler alert, Cloudflare is one of the stocks that I added to the position, but we'll talk a bit about that later on. Anyway, for me personally, I'm not really worried about Cloudflare for the time being, and I will continue to add to this position. If it's in the red and when it starts to turn into the green, then I'll just leave it and just let it ride until, my horizon is met. Now, let's go into the stocks that I've sold. So the first thing I'm going to do is go over to the general investment account. Free Trade has rebranded it from basic account to the general investment account. And typically speaking, the general investment account is actually the actual official name for any investment account within the UK that's not, a taxable account or a SIP or whatever. So they've just basically rebranded that to make that clear. But yeah, let's go on to here, and what you'll be able to see here is a whole bunch of free shares. But what you will see here is a British Land and a Landsec sell. So I've decided to get out of these REIT positions. I've decided to sell these REITs. My rationale for selling at a loss as well. So I want to be, transparent with you. I sold both of these two positions at around a 15% loss for each. And my rationale is opportunity cost, mainly speaking. I feel like putting this money into a business that I believe is genuinely has the good chance of growing their earnings and their revenue over the next 1 to 3 years. For me, I'm just kind of holding on to dead money at the time being. Now, initially I didn't want to be too haphazard, and what's the word I'm looking for, too kind of trigger happy basically, and just sell the moment the Divock 91 situation hit. So I read it out for a little bit, but ultimately I just don't think it fits in terms of my current strategy, which is the same strategy that I talked to you guys about at the beginning of 2020. Go check out the 2020 vision, and it's basically going into US high growth tech stocks and then maintaining a smaller portfolio for dividends and so forth. Now, these two businesses aren't even paying dividends, so effectively they don't even fit into any of the two criteria that I basically have. So ultimately it had to go, man. And I think I probably waited a little bit too long for this. There was an opportunity to probably sell at around 7 to 10% loss, maybe about a month or so back. But it is what it is. I think the money that I've lost, I will definitely recoup in other positions. So yeah, British Land and Landsec, both gone. And that means now that I don't have any money in my general investment account. The money you see here is just basically free share money that I've got, which I just sell and liquidate, and then I'll probably move to the ISA as and when. But I won't really be using the general investment account anymore. So when I do these updates, pretty much the whole update will be within the investment ISA. Once I max out my ISA, then obviously it's going to be trading 212. So what you can basically see here is I've got about 4,000 here cash waiting to invest into some stocks next week, which we'll talk a little bit about later on in this video. And then of my ISA allowance remaining is 1682. So naturally this is not obviously money that I've added in because I've earned that money or whatever. It's basically money just moved from one account to the other, but it does come out of my ISA allowance, unfortunately. So I could have probably just left that money in the general investment account and then just continue to add my normal amount of money on a monthly basis to my ISA up until April next year. But because I wanted to make sure that I started to utilize that money and put that money to work, I moved it over to here. Once I maximize my ISA, I'm basically gonna just continue investing into trading 212. Ultimately, if I can't add money to my ISA, there's no point me doing it into the general investment account. And from a cost perspective, the FX rates is cheaper in trading 212. So obviously there is no FX rate. Effectively, there's no spot rate. So because of that, that means that it's going to be cheaper for me to buy some of those US businesses. I can add more money to the pies, so the pies that we talk about on a weekly basis. I can definitely add more money to those pies as well. So the money that I'm currently doing is like £100 a month on two of the pies, and £300 I think on another pie. So I can actually make that a lot higher. And then also if there's individual US tech stocks or businesses that I want to invest in, then that will actually happen within trading 212 if I'm unable to do it within my ISA for the time being, and an opportunity comes up. So yeah, that's basically my plan for the time being, and why you see this kind of little spike up that we just talked about here. Now, the two stocks I sold, British Land, Landsec. The next stock that I've sold is Virgin Money. So Virgin Money, I sold Virgin Money. And listen, Virgin Money was the hardest decision out of all of the stocks that I'm going to mention to you today. Virgin Money was absolutely the hardest decision. You know, this again is a stock like Sentiment that I've bought and I've held for 2 years now, since the very beginning. I saw a lot of potential with Virgin Money. It used to pay a dividend, and then obviously it stopped paying a dividend because it focused on being a bit more of a growth stock, and reinvesting that money back into the business. But to be honest, you know, Virgin Money, if we just look at the graph, it's just had some incredibly bad times upon bad times in terms of the UK economic landscape. I'm more selling this not because of the Virgin Money business overall, but I'm more selling this business because, you know, it's a financial business within the UK, and ultimately the UK financially is just on the ropes right now. You feel me? It's on the ropes. It's just not stable. And I think any financial business that's living within the UK, when I say financial business, I mean a business that deals in finance. I'm not talking about, you know, the finance of, you know, a restaurant business or whatever. I'm talking about a bank is a financial business, and I just find that it's just going to be a very, very difficult time for them for I think the next, you know, I would say the next 6 months, until a time comes where we kind of are looking like we're going to be coming out of a recession. I think it's just going to be a very difficult time. So although I do feel that, you know, this is actually a good business, and I will make that claim, I genuinely feel Virgin Money is a good business. I don't think it's a bad business whatsoever, but you can just see that stock market performance. The max performance is a 52% decline. You know, this year is a 20% decline. I would much rather just put my money into businesses that I feel like has the opportunity to grow, or just leave it in cash. Like, I can literally just leave that money in cash, and, you know, the worst thing that's going to happen to me is a slight inflationary decrease of, you know, whatever inflation is, which is basically nothing anyway. So I feel like, you know, again, it was hard for me to sell this business. I don't think that this business is bad in any way, shape or form. I just feel like the macro conditions that this business sits within just is not an environment that will allow this business to thrive in the short term. But maybe Virgin Money might reappear in the portfolio again in the medium or long term, who knows. But at the moment, it was time to go, and that's why I sold Virgin Money. So again, I sold this at a bit of a loss. It was around, I think, a 7% loss. I can't even remember now, but it's all good. It's all good. Virgin Money is now the third business that I've sold within my portfolio. Then now, 2 more businesses. The next one that I sold was Aviva. So I sold Aviva. Aviva, for me personally, was always one of the candidates to basically sell. And ultimately, again, it's a very similar story to Virgin Money. A financial business within the UK, for me, it's just a lot of risk. And when I evaluate this versus Legal & General, if I am to hold one, Legal & General is one I would much prefer to hold. They maintain their dividend throughout. They're typically a better run business. Although Aviva does look like it's going to be a lot more promising with their new CEO, with their new chairman. And we talked a little bit about, you know, some of the things that they're doing to try and get to that £3.50 price target, which I think they do have the opportunity to get. So listen, if in a month's time they're now at £3.50, I'm not really going to feel any type of way. I had quite a big holding in Aviva, as you can see, £4,000 there. So I wanted to obviously put that money to work in businesses that I definitely believe in, and obviously grow those businesses and grow my value and my net worth that way. So again, I'm not really that sad about selling Aviva. I've always talked about selling Aviva for many months, and I just finally pulled the trigger this week. This week was an opportunity to pull the trigger, not because Aviva was doing so well that I wanted to recoup the profits. It was more because all of the stocks that I wanted to buy was doing so poorly, that it gave me an opportunity to buy them at lower valuations. So that's the reason why I sold Aviva. And the last one that you may have saw that I've also sold is Taylor Wimpey, which we talked about like last week, I think. Last week we talked about selling Taylor Wimpey, and I've basically done that as well. Again, there was a few businesses when I first started investing that I kind of duplicated from an industry standpoint, which, you know, it all depends what you want to do. Like, I've got multiple tech stocks, right? You can have Amazon and a Shopify. I currently don't hold either, but potentially you could do that if you wanted to. You can have a Neo and a Tesla. You know, you can have a PayPal and a Square. It's completely your choice what you want to invest in. But at the beginning, I did everything purely based on fundamentals. Like, it was exclusively a fundamentals based approach, and that meant finding that certain industries actually shone higher than other industries. So what you found is that when I've invested in my first 10 stocks, there was Taylor Wimpey and a Barrett. There was Aviva and a Legal and General. There was a Lloyd's, Barclays and a Virgin Money. So there was obviously a lot of duplication there in terms of certain businesses. Now, what I've basically found is that some businesses I've preferred their performance over others. I've preferred the performance of Barrett over Taylor Wimpey. Now, Taylor Wimpey last year was actually a very well-performing stock. It was a decent stock last year. You'll be able to see it from this max graph that, you know, from the time that I bought it to, which was around, no, it's too far. I bought it around October 2018. You know, it went up quite considerably. But then obviously it's been volatile and overall it's kind of gone down again this year. It's not been that great, and I think again it's a very similar example of, you know, opportunity cost, where I can put that money into something else and obviously get a bigger return in buying businesses that I already believe in. So just concentrating my portfolio a little bit more rather than being so broadly divested, and that way I can hopefully gain a bigger return in the long term. So yeah, Taylor Wimpey was the next stock. So yeah, the stocks that I sold was British Land, Landsec, Virgin Money, Taylor Wimpey and Aviva. The stock that I bought this week, obviously as you guys saw, was Tesla. Now I said to you, the moment I buy Tesla, the stock's going to go down. I did say this to you, man. I know a lot of you lot think I bang judge or something on these stocks. I don't bang judge. I'm just very good at predicting what's going to happen. And to be fair, I'm good at predicting when I actually put my money into it and it's negative. Let me actually be clear. I'm not good at predicting positive. I'm just good at predicting negative crap. And ultimately, I felt that, you know, when Tesla did their stock split, it started to run up again. And I just felt like, you know what? Let me just get into it now and just not wait until you know, I mess around, wake up one morning, it's like $700 after the stock split, and then I feel like it's too expensive again. So I actually just invested into it at that point. It did go up a little bit, but then obviously it started to go down. Now listen, I think Tesla needed to go down. It doesn't really bother me, to be honest, because I'm going to continue buying into Tesla, you know, month after month, because I do feel that long term it's a business that, you know, obviously probably all of you, if not a very large number of you, hold, and you probably know more about the business than me. I mean, I know about Tesla, but you might know like the nitty gritties, the ins and outs a little bit more than me. I'm going to be honest with you, I still think Tesla is an overvalued business. I think it's heavily overvalued. Its PE ratio is still like, you know, over 1,000. When you're buying Tesla, you're not buying the fundamentals, unfortunately. You're buying the future prospect. You're buying the 2025 potential of the business. You're buying the 2024 potential of the business, and you're buying that, you know, now, currently at these prices. Now, I think a cool off was needed, and I think Tesla had to lead the way in that. So it doesn't really bother me. You know, ideally, could I have waited until the end of the week? And, you know, would I have preferred to wait to the end of the week and bought it at, you know, today's price rather than buying it at, you know, what the price was on Monday when I bought it? Of course, naturally, you always want to buy it as cheap as you possibly can buy. It's part and parcel. So that's just facts. Ultimately, it's not going to have that big a difference when I am thinking about the 5-year horizon, or maybe even, you know, longer with Tesla, maybe the 10-year horizon with this business. So, you know, again, it was needed to happen. I'm not surprised by it. It kind of was expected. It's just funny that of all of the weeks of it continuously to go in one direction, you know, no Zayn, no Malik, but listen, all of the weeks it was going in that one direction, the week that I actually invested into it, it then started to drop. You know what I mean? I didn't bag no judge on it. But sometimes you've got to day trade the other direction and just offset, you know, your losses, which, you know, sometimes I do. Anyway, let's move on. I bought Tesla. That is now a stock you'll see within my portfolio. And naturally, obviously, if there's going to be any news about Tesla on a week-by-week basis, and it lands within the top movers and fallers, we're going to be talking a bit about Tesla. Now, the stocks that I added to their position, we mentioned again earlier on Cloudflare. So Cloudflare, I added about 500 to position. You can see that I've done about 4 rounds of investing into Cloudflare, and I think I will continue to add more money into Cloudflare, currently at a 15% loss. So any money that I add is obviously getting it at a lower valuation and reducing my average share price on that. So I'm more than happy. But the other two stocks, I was in profit. I was in significant profit on the other two stocks, and I added to it. And I realized that, I was in profit and I didn't want to add to it purely for vanity and purely for optics, because I didn't want to reduce the 60% profit I was on one stock. I didn't want to reduce the 110% profit that I was with the other stock. But then I thought about it, more pragmatically speaking, and ultimately, because I believe in these stocks for the long term, I need to increase my holdings into these positions. And eventually, when I get into 100% territory again, it's going to be 100% on a bigger volume of shares, which is ultimately going to have a better impact for me in the long term. So that's the reason. So the first stock was Apple. Apple, I added another 1,500 into this business. Obviously, Apple's again one of the stocks that's had a bad week, but not necessarily that bad compared to some of the other stocks we've seen. And I think I probably will add more to Apple. So I have reduced my percentage from, I think, about 60% it was this week to about 28%, notwithstanding however much it went down, obviously, through the natural course of this week. So around that. But Apple is definitely a stock I'm going to continue to be holding for quite some time. And then the next stock that I added to was AMD, always making dough. AMD for me was quite frankly the best buying opportunity that I saw from all of my businesses. So I added £1,600 to AMD. Again, this is all just from stocks that I've sold. So, not any new money or whatever. This is just quite simply stocks that I've already sold, adding that money into stocks that I actually believe in for the long term. So AMD went down to $82. AMD is definitely going to go back up to being $100 stock, which it was just not too long ago, or $92, but it's going to get to being $100 stock. So obviously I will be benefiting from that 20% increase from whatever that share price is today. And I am thinking of maybe even adding just a little bit more to AMD, but there's a few more things I need to consider and think about, because I've got 4,000, as I mentioned, left. I've got 1,682 available at my ISA allowance, which will probably go by, within a couple of months at least, if not next month. And then, that's it for the ISA. So, the question then becomes, are you going to buy any new stock, or are you just going to continue to add to these existing stocks within your current ISA? There is a few stocks on my watch list, as you can see, from iRobot, Nvidia, Salesforce has been on my watch list, Disney, Spotify, Splunk, The Trade Desk, ServiceNow, Virgin Galactic, Autodesk, Akamai, Shopify, NXP Semiconductors, Amazon, Zendesk, Google, Atlassian, Boohoo and Ocado got added to my watch list from the Instagram post that I've been doing. Follow on Instagram at Infinite Investors if you want to check out those stock pit posts that I've been doing. So yeah, there's a few stocks that I'm currently evaluating at the moment. I kind of know which stocks I'm inclined to add into the ISA if I'm going to do so, but at the same time, I also want to make sure that I, add more to positions like Tesla, add more to positions like Cloudflare, add more to positions like Apple and AMD if I can possibly do so. And as I mentioned earlier on in this video, I want to add more to PayPal and Okta as well, because I feel like, for the performance that you can see there, they're quite small holdings now contextually to, my portfolio. So, I would like to definitely add a little bit more to those positions. In terms of other stocks that I might sell, obviously we talked about Imperial Brands. Lloyd's I'm not selling. Lloyd's I'm just going to continue to hold until next year. If Lloyd's goes down to 20p or like 15p, then obviously I might just sell it. That's going to be a considerable drop from the days I was buying it at 60p. But if Lloyd's can maintain around the current share price that it's currently sitting at, by the time it reinstates their dividends, I think Lloyd's could be a good earner for me. So I'm going to continue to hold Lloyd. I'm going to continue to hold Legal & General, definitely continue to hold Sentiment, definitely continue to hold Barrett, and obviously Imperial Brands will go. So for those that think that I don't have UK businesses, I still have UK businesses within the portfolio. I currently hold only 13 stocks now, and 5 of them are UK businesses. So yeah, I'm still, relatively speaking, do have good exposure into the UK, but I think obviously the US is now going to be the lion's share of my current portfolio. So yeah, in next week's video, you might see a few more stocks that I've bought. You might see a few more stocks that I've sold in the case of Imperial Brands, or you might just see me adding to, you know, certain existing positions, because, you know, that's what I'm currently evaluating over the next couple of weeks. So yeah, it'll be interesting to see what happens next week, and obviously that will then dictate what I then do. Hopefully you found this video useful. If you did, like, comment, subscribe, hit that bell, follow on Instagram and Twitter, and I will catch you next week with another portfolio update. Take care, guys. Peace.